Right now, while you're watching this, there's a trader somewhere in the world making more money by doing absolutely nothing than you've made in your last 50 trades combined. That's not an exaggeration. That's not motivational speaking. That's a mathematical reality that I'm about to prove to you with data that will fundamentally change how you think about trading forever. The trader I'm talking about isn't smarter than you. They don't have better software, faster connections, or access to secret information. They have something far more powerful, something that costs nothing but that 95% of traders will never possess. They have the ability to sit on their hands and watch opportunity after opportunity pass by without feeling even the slightest urge to act. And this single ability, this one psychological skill that everyone dismisses as boring or old-fashioned, is generating returns that would make your head spin. In the next hour, I'm going to show you exactly why the best trade you'll ever make is the one you don't take, and how doing less can make you exponentially more money than the frantic, exhausting, constantly active approach that the entire trading industry has brainwashed you into thinking is the path to success. What I'm about to share with you goes against everything you've been taught, everything you've seen on social media, and everything the brokers want you to believe. But it's backed by decades of research, millions of dollars in trading data, and the actual results of every consistently profitable trader I've studied in my 15-year career. Let me take you back to a moment that changed everything I understood about trading. It was a Tuesday morning in March, and I had been watching a particular stock for 3 weeks. The setup was textbook perfect. Every indicator I respected was lining up like synchronized swimmers. The moving averages were crossing exactly as they should. The volume was building in that beautiful, organic way that suggests real institutional accumulation rather than retail frenzy. The relative strength index was bouncing off support in a pattern that had worked 17 times out of 20 in my back testing. My analysis told me this stock was about to explode higher, and I had calculated my entry point, my stop loss, and my profit targets with mathematical precision. I was ready. I was prepared. I was convinced. And then I made the decision that would teach me more about trading than any book, course, or mentor ever could. I decided to wait one more day. Just one more day to see if the pattern would confirm with one additional piece of evidence. That night, after the market closed, the company announced an unexpected regulatory investigation. The stock gapped down 18% at the open and never recovered. My patience, my willingness to wait just 24 more hours had saved me from what would have been one of the most devastating losses of my trading career. Now, you might think that was just luck. You might say I got fortunate with timing. But here's what I discovered when I started really analyzing not just my own trading history, but the trading records of hundreds of successful traders I've studied, interviewed, and learned from over the past 15 years. Patience wasn't luck at all. Patience was the single variable that separated consistent winners from everyone else. When I went back through my trading journal and marked every trade where I had waited at least 3 days after first identifying an opportunity versus trades where I jumped in within hours of seeing a setup, the difference was staggering. The trades where I practiced patience had a success rate of 68%. The trades where I acted quickly had a success rate of 41%. That's not a small edge. That's not a marginal improvement. That's the difference between building wealth and destroying capital. That's the difference between becoming financially free and giving up on trading altogether, convinced that the markets are rigged or that success is only possible for insiders with special information. The financial industry has sold us a lie. And it's a lie that makes them richer while keeping us perpetually spinning our wheels. They've convinced us that trading is about action. They've built their entire marketing machine around the idea that successful trading means being active, aggressive, and constantly involved in the markets. Think about every trading advertisement you've ever seen. Think about every broker commercial, every trading platform promotion, every financial media segment. What do they show you? They show you traders intensely focused on screens, rapidly clicking mice, dramatically executing trades, celebrating quick profits. They show you movement, action, urgency. They never show you what real trading success actually looks like, which is someone calmly reviewing their plan, patiently waiting for their specific criteria to be met, and then, only then, executing a trade with the emotional temperature of someone ordering coffee. The reason they don't show you that reality is brutally simple. Patience doesn't generate commissions. Waiting doesn't create trading fees. Restraint doesn't produce the transaction volume that brokers need to stay profitable. Every time you make a trade, someone gets paid. Every time you buy or sell, money flows out of your account in the form of commissions, spreads, slippage, and fees. The more you trade, the more everyone else makes, regardless of whether you win or lose. Let me share some numbers with you that the industry desperately doesn't want you to think about too carefully. The average day trader makes approximately 50 to 100 trades per month. At even the most competitive commission rates, that's somewhere between $50 and $200 in direct costs every single month, or $600 to $2,400 per year. But that's just the visible costs. The invisible costs, the spread between bid and ask prices, the slippage from your intended entry price to your actual fill, the market impact of your orders, these hidden costs typically equal or exceed your direct commission costs. So now we're talking about $1,200 to $4,800 per year in total trading costs before you've made a single dollar of profit. Now compare that to a patient trader who makes 6 to 12 carefully selected trades per year. Their total costs might be $100 to $300 annually. Before either trader has demonstrated any skill, any edge, or any analytical ability, the active trader is starting nearly $4,000 behind the patient trader. That's not a level playing field. That's a rigged game that the patient trader wins before the starting gun even fires. But the real cost of impatience goes far deeper than fees and commissions. And this is where most traders completely miss what's actually happening to them. Every time you take a trade that doesn't meet your highest standards, you're not just risking money on that specific trade. You're creating a psychological pattern that will sabotage every future trading decision you make. Your brain is an incredibly sophisticated pattern recognition machine, but it has one critical weakness that is absolutely devastating for traders. It learns from your behavior faster than it learns from your intentions. When you tell yourself you're going to wait for perfect setups, but then you take marginal trades because you're bored or anxious or excited, your brain doesn't remember what you said. Your brain remembers what you did. And the next time you're evaluating a setup, your brain will push you toward that same impulsive behavior because that's the pattern you've reinforced. This is why traders who start their careers with impatient habits almost never break them. It's not because they lack discipline in some abstract sense. It's because they've literally wired their brain to respond to market stimuli with immediate action rather than thoughtful evaluation. They've trained themselves through thousands of repetitions to be the kind of trader who loses money. The neuroscience behind this is fascinating and terrifying in equal measure. When you see a potential trading opportunity, your brain releases dopamine, the same neurotransmitter that's involved in addiction, anticipation, and reward-seeking behavior. This dopamine hit feels good. It feels exciting. It feels like possibility and potential and hope. Your prefrontal cortex, the part of your brain responsible for rational decision-making and long-term thinking, tries to intervene with questions like, "Does this really meet my criteria?" Or, "Should I wait for more confirmation?" But here's the problem. The dopamine response is fast and powerful, while your prefrontal cortex is slow and easily overwhelmed. If you act on that initial impulse and take the trade, your brain experiences a second dopamine hit from the action itself. You've now reinforced the impulsive pathway twice in rapid succession. Even if the trade loses money, the immediate dopamine response from identifying an opportunity and taking action creates a reward cycle that your brain wants to repeat. This is why traders often feel a genuine compulsion to trade even when they intellectually know they should wait. They're not weak-willed or undisciplined. They're fighting against one of the most powerful neurochemical systems in the human body, and they're fighting with a strategy that makes them weaker every time they lose the battle. Now let's talk about what happens in your brain when you practice patience, because this is where the whole game changes and where you start building the psychological foundation that separates professional traders from gambling addicts who happen to use stock tickers instead of slot machines. When you identify a potential trade but consciously decide to wait for additional confirmation, something remarkable happens in your neural architecture. Your prefrontal cortex, that rational decision-making center that got overwhelmed by the dopamine rush, actually gets stronger. Neuroscientists call this building executive function, and it works exactly like building muscle in the gym. Every time you resist an impulsive urge and choose a thoughtful response instead, you're literally growing new neural connections that make the next decision slightly easier. The first time you decide to wait instead of trading immediately, it feels almost physically painful. Your hands might shake. You might feel anxiety or fear that you're missing out. You might obsess over the trade for hours, constantly checking the price, second-guessing your decision to wait. This discomfort is real, but it's also temporary, and it's the price of admission to becoming a successful trader. The second time you practice patience, it's maybe 5% easier. The 10th time, it's 20% easier. By the 100th time, waiting for your perfect setup doesn't feel like deprivation anymore. It feels like power. It feels like control. It feels like you've discovered a secret weapon that nobody else knows about. And here's the truly beautiful part. While you're building this psychological strength, you're simultaneously teaching yourself to recognize genuinely high-quality trading setups. When you take every trade that looks remotely interesting, you never develop the pattern recognition skills to distinguish between a good opportunity and a great opportunity. Everything looks the same when you're acting impulsively, but when you force yourself to wait, to watch, to observe how different setups actually develop and resolve, you start seeing patterns that are invisible to impulsive traders. You notice that certain types of price action that look bullish actually precede drops 70% of the time. You recognize that specific combinations of volume and volatility tend to produce false breakouts rather than sustainable trends. You develop what traders call market feel, which isn't mystical or magical at all. It's simply the accumulated wisdom of thousands of hours spent watching without acting, observing without interfering, learning without losing money. Let me tell you about a trader I mentored who exemplifies this transformation better than anyone I've ever worked with. His name is Marcus, and when he first came to me, he was trading approximately 40 times per month and losing money consistently, despite being genuinely intelligent, well-educated, and committed to success. He had read all the right books, taken several courses, and could explain technical analysis concepts with impressive sophistication. His problem wasn't knowledge. His problem was that he couldn't sit still. He was what I call a motion addict, someone who had convinced himself that being active in the markets was the same thing as being productive. I gave Marcus one simple assignment that he initially thought was insulting in its simplicity. Watch the markets every day for 30 days without making a single trade. Not one. He was allowed to paper trade, to write in his journal, to analyze charts, to do anything except put real money at risk. He thought I was crazy. He argued that 30 days without trading would cause him to miss countless opportunities. He worried that he would lose his edge or his feel for the markets. But he had tried everything else, and nothing had worked. So he reluctantly agreed to my experiment. The first week was torture for Marcus. He would call me almost daily, describing setups that he was certain were going to work, begging me to let him take just this one trade because it was so obvious. I refused every time. The second week was slightly easier, but he was still miserable, still feeling like he was missing out on profit opportunities. Then something interesting happened in week 3. Marcus called me with a completely different tone in his voice. He told me he had identified what he thought was a perfect trade early in the week, a stock that all his indicators said was about to break out. Instead of taking it, he had simply watched it. The stock did exactly what he predicted. It gapped up strongly on Tuesday morning. Old Marcus would have felt vindicated and frustrated that he hadn't traded it. But this new Marcus, this patient Marcus, kept watching. By Thursday, the stock had completely reversed, giving back all its gains and dropping below where it started. Marcus told me, "If I had taken that trade like I normally would have, I would have bought Tuesday morning after the gap, held through Wednesday expecting more gains, gotten scared on Thursday, and sold at a loss. By waiting, by just watching, I saved myself money and learned something I never would have learned otherwise. My entries are consistently late because I wait for confirmation that everyone else is also seeing." By the end of the 30 days, Marcus had transformed not just his trading, but his entire understanding of what trading actually is. He made his first trade on day 31, a carefully selected opportunity that met every single criterion in his trading plan. He held that trade for 8 days, managing it according to his predefined rules, and closed it for a gain of 7%. That one trade made him more money than his best month of active trading ever had. More importantly, he executed it with complete emotional calm. There was no anxiety about whether he was right. There was no compulsion to check the price every 5 minutes. There was no second-guessing or impulsive adjustments to his plan. He simply executed what he had decided to do, and then he waited again. Over the next year, Marcus made exactly 18 trades. 18 trades in 12 months, compared to his previous pace of 40 trades per month. His winning percentage went from 38% to 72%. His average gain on winning trades more than doubled because he was holding positions longer and letting profits run. His average loss on losing trades decreased by 40% because he was only taking the highest quality setups where his stop losses were logically placed rather than arbitrary. Most remarkably, he finished the year up 63% in a market that was essentially flat, and he did it while spending less time looking at charts, feeling less stress, and actually enjoying trading for the first time in his life. Marcus's story isn't unique or special. I've seen this pattern repeat with every trader who genuinely commits to practicing patience as a skill rather than viewing it as a personality trait they either have or don't have. That distinction is crucial, so let me repeat it. Patience is not a personality trait that you're born with or without. Patience is a skill that you can deliberately practice and systematically improve. When people say, "I'm just not a patient person," what they're really saying is, "I haven't yet built the neural pathways that make patience feel natural." That's a fixable problem. That's a solvable challenge. That's the difference between staying stuck where you are and transforming into the kind of trader who actually makes money consistently. The method is simple, though not easy. You start by committing to wait a specific amount of time before taking any trade. If you currently jump on opportunities within minutes or hours of seeing them, commit to waiting 24 hours. Set a literal timer if you need to. When you see a setup that excites you, write it down, save a chart image, document everything about why it looks good, and then do absolutely nothing for 24 hours. When those 24 hours are up, review your analysis. Ask yourself, is this still as compelling as it was yesterday? Has anything changed? Have I identified any reasons not to take this trade? You'll be shocked at how many setups that seemed absolutely certain in the moment look mediocre or questionable a day later. Once waiting 24 hours becomes comfortable, extend it to 48 hours, then 3 days. The specific time frame matters less than the practice of building that pause between stimulus and response, that gap between "I see an opportunity" and "I risk my capital." This gap is where professional trading lives. This gap is where you stop being a reactive gambler and start being a strategic investor. This gap is where patience transforms from an abstract virtue into a concrete competitive advantage that shows up in your account balance. But there's another dimension to patience that we need to explore, and it's one that most trading education completely ignores because it's uncomfortable to talk about and difficult to quantify. The dimension I'm referring to is patience with yourself, patience with your learning process, and patience with the timeline required to actually become consistently profitable. The trading industry has created completely unrealistic expectations about how quickly people should be able to master these skills. You see advertisements showing people who went from complete beginners to full-time traders in 6 months. You hear stories about traders who turned small accounts into millions in a year. These outlier stories, these extreme exceptions, have become the benchmark against which everyone measures themselves, and it's destroying people's trading careers before they even really begin. Let me give you some reality that you desperately need to hear. The average timeline for becoming a consistently profitable trader, according to studies of professional traders across multiple markets, is somewhere between 3 and 5 years of serious, focused practice. Not 3 to 5 years of casual dabbling. Not 3 to 5 years of reading books and taking courses while barely trading. 3 to 5 years of actively trading, reviewing trades, learning from mistakes, refining your process, and building the psychological resilience that trading demands. Some people do it faster. Many people take longer. But if you've been trading for 6 months or a year and you're not consistently profitable yet, you are not behind schedule. You are not failing. You are exactly where you should be, assuming you're genuinely treating this as a skill to develop rather than a lottery to play. The problem is that most traders quit long before they've given themselves a real chance to succeed. They expect results in months that realistically take years, and when those unrealistic expectations aren't met, they conclude that trading doesn't work or that they don't have what it takes. This brings us to one of the most counterintuitive truths about trading success, and it's a truth that will either liberate you completely or make you angry enough to close this video and never think about it again. The truth is this: the less you need trading to work, the more likely it is to work for you. Read that again because it's one of those statements that sounds like meaningless wordplay until you really understand what it means. Traders who desperately need to make money from trading, who are counting on trading income to pay bills or replace their job or prove something to themselves or others, almost always fail. This isn't because the universe is cruel or because markets punish the needy. It's because desperation and patience are psychologically incompatible states. When you need something to work, you cannot wait for it to work properly. You force it. You rush it. You take marginal opportunities because you can't afford to miss any opportunity. You cut winners short because you need to lock in gains. You hold losers too long because you need them to come back. Everything you do is contaminated by that need, and markets are extraordinarily efficient at extracting money from contaminated decision-making. The traders who succeed are the ones who can genuinely, authentically say, "I don't need this to work right now." They have other income sources that cover their bills. They have capital that they can afford to lose without catastrophic consequences. They have identities and self-worth that aren't tied to their trading results. This financial and psychological buffer gives them something that desperate traders can never have: the ability to wait indefinitely for exactly the right opportunities. When you don't need to trade, you can watch a market for weeks or months without taking a position. You can sit through entire news cycles, earnings seasons, and market trends without feeling compelled to participate. You can watch other traders make money on opportunities that don't fit your specific criteria without experiencing soul-crushing FOMO. This isn't just a psychological advantage. This is the entire game. Because here's what most traders don't realize. In any given year, there are only a handful of truly exceptional opportunities in any particular market. I'm talking about setups where everything aligns perfectly, where the risk-reward is dramatically skewed in your favor, where the probability of success is as high as it ever gets in an inherently uncertain domain. These opportunities might appear 5 times a year, maybe 10 times if you're watching multiple markets. Definitely not 50 times. Definitely not 200 times. The math here is devastatingly simple. If there are approximately 10 exceptional opportunities per year in your chosen market, and you make 200 trades per year, then at most 5% of your trades are actually exceptional opportunities. The other 95% are, by definition, Mediocre or poor opportunities that you're taking because you can't sit still, because you're bored, because you're trying to force the market to give you action when action isn't warranted. Now think about the quality difference between those 10 exceptional trades and the 190 mediocre ones. The exceptional trades probably have win rates above 70 or 80% and risk-reward ratios of 1 to 3 or better. The mediocre trades probably have win rates below 50% and risk-reward ratios of 1 to 1 or worse. If you only took the 10 exceptional trades, you would almost certainly make money over the year. If you take all 200 trades, you're almost certainly going to lose money or tread water once you factor in all the costs we discussed earlier. The patient trader makes 10 trades and wins on 7 or 8 of them. The impatient trader makes 200 trades and wins on maybe 90 or 100 of them. The impatient trader has more winning trades in absolute numbers, but the patient trader makes dramatically more money. This is why the statistics on trading success are so bleak. Study after study shows that somewhere between 80 and 95% of retail traders lose money over time. But what those studies don't usually break down is the correlation between trading frequency and losses. When researchers do look at this variable, the results are consistent and conclusive. The more frequently people trade, the more likely they are to lose money. This isn't a small effect. This isn't a marginal correlation. This is a powerful, robust relationship that holds across different markets, different time periods, different experience levels, and different capital sizes. The most active traders have the worst results. The least active traders have the best results. The relationship is so strong that you could use trading frequency alone as a predictor of long-term success with better accuracy than most complex prediction models. Yet the entire retail trading industry is built on encouraging maximum trading frequency because, again, every trade generates revenue for someone other than you. The incentives are completely misaligned. The people teaching you to trade are incentivized to make you trade more. The platforms you use are incentivized to make trading as easy and frictionless as possible. The media you consume is incentivized to make markets seem constantly actionable, constantly moving, constantly full of opportunities you can't afford to miss. You are swimming in an environment that is deliberately engineered to make you impatient, and the only way to survive is to recognize that engineering and consciously fight against it every single day. Fighting against it means creating what I call friction systems, deliberate obstacles between you and the ability to execute trades. Some traders require themselves to fill out a detailed checklist before any trade, and the act of writing out their reasoning creates enough pause to prevent purely impulsive decisions. Some traders use separate accounts for discretionary trading with withdrawal delays, so they literally cannot access funds immediately even if they want to. Some traders work with accountability partners who they must text before taking any position, creating a social friction that slows down impulse trading. The specific method matters less than the principle. You need to intentionally make trading harder, slower, and more deliberate, because the default state of modern trading platforms is dangerously easy, fast, and frictionless. I personally use a combination of systems that have evolved over years of learning what my specific psychological weaknesses are. I maintain a trading journal where I must write a minimum of 200 words explaining my rationale before I can take any position. This sounds simple, but writing 200 coherent words about why a trade makes sense takes at least 10 to 15 minutes, and that time gap is usually enough to let any impulsive emotional energy dissipate. I also follow what I call the 3-day rule, which states that I cannot take any trade on the same day I first identify it. The earliest I can enter a position is 3 full days after I first add it to my watch list. This rule has saved me from more bad trades than I can count because a huge percentage of setups that look compelling on day 1 look much less interesting by day 3. The market has either moved without me, additional information has emerged that changes the picture, or I simply see with fresh eyes that what I thought was a high probability setup was actually wishful thinking dressed up in technical analysis. I also only allow myself to check my positions once per day at a specific time that I've predetermined. This rule might sound extreme or even reckless to traders who monitor their positions constantly, but it's actually made my results dramatically better. When you check positions continuously throughout the day, you're subjecting yourself to a stream of essentially meaningless price fluctuations that trigger emotional responses and impulsive adjustments to your plan. Every uptick creates a temptation to take profits early. Every downtick creates anxiety about cutting losses. By checking only once daily, I'm seeing actual meaningful price movement rather than noise, and I'm making decisions based on my plan rather than my emotions. These friction systems work, but they only work if you actually implement them and follow them, even when your brain is screaming that this particular trade is special and doesn't need the normal rules. This is where most traders fail. They create rules. They understand intellectually why the rules matter. They genuinely intend to follow the rules. And then in the moment, when they see what looks like an incredible opportunity, they convince themselves that this situation is different, that the rules don't apply this time. That they would be foolish to let this setup pass just because of some arbitrary restriction they imposed on themselves. This is your addiction talking. This is your impatience rationalizing itself. This is the part of your brain that wants immediate gratification coming up with sophisticated-sounding reasons why immediate gratification is actually the wise choice in this particular instance. The only way to fight this is to make your rules absolutely non-negotiable. Not follow the rules unless there's a really good reason not to. Not follow the rules most of the time. Follow the rules without exception, period. Even when it feels stupid, even when you miss opportunities, even when you watch trades work out exactly as you predicted, but couldn't take them because they didn't meet your criteria. This is the price of building discipline. You will miss good trades. You will feel frustrated. You will question whether all this structure and restriction is really necessary. And then, over time, you will notice that your results are getting better. Your stress is decreasing, and your confidence is growing because you're building a track record of actually doing what you say you're going to do. There's a fascinating study from behavioral economics that every trader should know about, conducted by Brad Barber and Terrence O'Dean at the University of California. They analyzed the trading records of over 66,000 households at a large discount brokerage over a 6-year period. What they found was remarkable. The average household earned an annual return of about 16%, which sounds pretty good until you realize that the overall market returned about 17.9% during that same period. So, the average active trader underperformed a simple buy and hold strategy by almost 2 percentage points annually. But here's where it gets really interesting. When they divided traders into quintiles based on trading frequency, the pattern was striking. The 20% of households that traded most frequently earned an annual return of 11.4%. The 20% that traded least frequently earned an annual return of 18.5%. The most active traders underperformed the least active traders by more than 7 percentage points annually. Over a 6-year period, that difference turns a $100,000 account into about $206,000 for the patient traders versus about $171,000 for the active traders. Same market, same time period. The only difference was patience, and that difference was worth $35,000. Now I want to address something that I know is going through your mind right now, because it goes through every trader's mind when they start understanding these concepts. You're thinking, okay, I get it, patience is important, but how patient is too patient? If I'm waiting for the absolute perfect setup, won't I barely ever trade? Won't I miss most of the market movement? Isn't there some balance between patience and action that I need to find? These are legitimate questions, and they reveal a fundamental misunderstanding about how professional trading actually works. The answer is not that you need to find some balanced middle ground between too much patience and too much action. The answer is that your goal should be to trade as infrequently as possible while still maintaining engagement with the markets and continuing to develop your skills. This is not the same thing as never trading. This is not the same thing as analysis paralysis, where you're so afraid of making mistakes that you can't pull the trigger on anything. This is about understanding that in trading, unlike in most other skills, doing less is usually better than doing more. Think about almost any other professional skill. If you want to get better at basketball, you need to practice shooting thousands of shots. If you want to get better at writing, you need to write millions of words. If you want to get better at surgery, you need to perform hundreds or thousands of procedures. In all of these domains, there's a relatively straightforward relationship between volume of practice and improvement in skill, assuming the practice is deliberate and thoughtful. Trading is fundamentally different. Trading is more like poker than it is like basketball. In poker, playing more hands does not make you better if those hands are marginal situations where your edge is small or non-existent. In fact, playing more hands in poker makes you worse because you're putting money at risk in situations where the math doesn't favor you over the long run. The best poker players are the ones who fold most of their hands, who sit patiently through long stretches of poor cards, and who only commit serious money when they have genuine statistical advantages. Trading works the same way. You don't get better at trading by taking more trades. You get better at trading by becoming more selective about which trades you take, and selectivity by definition means trading less frequently. This concept is so important and so misunderstood that I want to spend some time really breaking it down. When you take a trade, you're not just practicing trading skills, you're also reinforcing whatever decision-making process led to that trade. If you take a trade based on mediocre analysis or impulsive emotion, you're practicing mediocre analysis and impulsive emotion. You're literally training yourself to be worse at trading. The quality of your practice matters infinitely more than the quantity. And in trading, practice means only taking trades that meet rigorous standards. So what does this look like in practical terms? How do you define those rigorous standards? This is where most traders get stuck because they're looking for some universal set of rules that works for everyone, and those rules don't exist. What works for me won't necessarily work for you because we have different risk tolerances, different time horizons, different capital sizes, different psychological makeups, and different edges in the market. But what I can give you is a framework for developing your own rigorous standards, a process for defining what constitutes an exceptional opportunity for you specifically. The framework starts with honest self-assessment across several dimensions. First, you need to understand your actual edge, not the edge you wish you had, not the edge you think you should have, the edge you actually have based on empirical evidence from your own trading results. Most traders can't articulate their edge clearly. And if you can't articulate your edge, you almost certainly don't have one. Your edge might be that you're exceptionally good at identifying trend reversals in specific types of chart patterns. Your edge might be that you understand the fundamental economics of a particular industry better than most participants. Your edge might be that you have the psychological capacity to hold winning positions longer than the average trader. Whatever your edge is, you need to be able to state it clearly and then structure your trading process to maximize the deployment of that edge while minimizing exposure to areas where you have no edge or negative edge. Second, you need to define your optimal holding period based on both your psychological capacity and your analytical strengths. Some traders are genuinely skilled at very short-term price prediction, but terrible at longer-term forecasting. Other traders are exactly the opposite. There's no moral superiority to either approach. Day trading isn't less legitimate than position trading, but you need to know which time frame aligns with your actual abilities rather than which time frame seems most exciting or prestigious. I personally discovered that my optimal holding period is between 5 and 20 timbres. Anything shorter than 5 days and I'm basically guessing because short-term price movement is too random for my analytical methods to add value. Anything longer than 20 days and I start experiencing psychological discomfort that leads to poor decision-making. Other traders I know have completely different optimal windows. I know successful day traders who can't psychologically handle holding positions overnight. I know successful position traders who only take trades they expect to hold for 3 to 12 months. Neither approach is right or wrong. What's wrong is trying to trade in a time frame that doesn't match your skills in psychology just because someone told you that's how trading should be done. Third, you need to establish minimum edge requirements for every trade you take. This means explicitly defining how much better than random your trade needs to be before it's worth the transaction costs, opportunity costs, and psychological costs of taking it. A simple way to think about this is in terms of risk-reward ratios combined with probability estimates. If you're taking trades where you risk $1 to make $1, you need to be right more than 55 or 60% of the time just to break even after costs. That's a high bar, and if you're honest with yourself, most of your trades probably don't clear that bar. But if you're only taking trades where you risk $1 to make $3, you only need to be right 30 or 35% of the time to be profitable. This dramatically changes the calculation of what constitutes a good trade. The patient trader isn't trying to find opportunities where they can risk one to make one with 60% probability. The patient trader is waiting for opportunities where they can risk one to make 3 or 5 with 40 or 50% probability. These opportunities are much less common, which means much less trading. But when you find them, your edge is so large that you can be profitable even with a relatively low win rate. Fourth, you need to create explicit entry criteria that remove as much subjectivity as possible from your trading decisions. This doesn't mean you need to build a purely mechanical system, though that's one valid approach. What it means is that you should be able to look at a potential trade and check it against a specific list of requirements, and if the trade doesn't meet every single requirement, you don't take it. No exceptions, no special cases, no, this one feels different. Your entry criteria might include things like specific technical patterns, volume requirements, volatility conditions, market regime filters, fundamental factors, or anything else that your research suggests contributes to edge. The key is that these criteria need to be defined before you start looking for trades, not created on the fly to justify a trade you want to take for emotional reasons. I have a checklist of 12 specific items that must all be checked before I can take any trade. Some of these items are objective and mechanical. Price must be above the 50-day moving average. Volume must be above average for at least 3 of the past 5 days. The stock must be within 15% of its 52-week high. Other items on my list require judgment but are still clearly defined. The primary trend must be clearly bullish on multiple time frames. The risk-reward ratio must be at least 1 to 3 based on logical support and resistance levels. There must be a clear catalyst or fundamental reason why the price might move in my anticipated direction. When I first started using this checklist, I was shocked by how few opportunities actually met on 12 criteria. I was looking at dozens of potential trades every week, but maybe only 2 or 3 actually checked all the boxes. My initial reaction was that my criteria were too strict, that I was being too conservative, that I was going to miss too many opportunities if I maintained such high standards. But I forced myself to stick with the system for 6 months before evaluating whether to adjust anything. Those 6 months completely changed my trading career. My win rate went from about 45% to about 70%. My average gain on winning trades more than doubled. My average loss on losing trades decreased by about 40%. My total number of trades decreased by about 85%, which meant dramatically lower costs and dramatically less emotional strain. Most importantly, I started actually enjoying trading instead of experiencing it as a source of constant stress and anxiety. The checklist didn't just improve my results, it improved my entire relationship with the markets because I was no longer fighting against my own impulses. I had an external system that made decisions simple. Either something checked all the boxes or it didn't. No agonizing, no second guessing, no wondering if I should take a marginal setup just because I haven't traded in a while. This brings me to what might be the most important point in this entire discussion. and it's something that took me years to fully understand and accept. The primary purpose of patience in trading is not to find better trades, though that's certainly a benefit. The primary purpose of patience in trading is to protect you from yourself. Your biggest enemy in trading is not market volatility, institutional manipulation, high-frequency traders, or any external factor. Your biggest enemy is your own brain's desperate need for stimulation, action, and the emotional satisfaction of doing something. Human beings evolved in environments where taking action was almost always better than doing nothing. If you saw a potential food source, you grabbed it because you didn't know when the next one would appear. If you saw a potential threat, you ran or fought because hesitation could be fatal. If you felt bored or restless, you explored or played or socialized because those activities increased your chances of survival and reproduction. We are literally wired at the deepest neurological levels to prefer action over inaction. And this wiring was highly adaptive for 99% of human history. But in trading, this ancient wiring is catastrophically maladaptive. In trading, the instinct to act when you see opportunity is the instinct that destroys accounts. The discomfort of sitting still while markets move is the discomfort that you must learn to embrace rather than escape. Patience in trading is really just another word for emotional regulation. It's the ability to feel the powerful urge to take action and choose not to act on that urge. It's the capacity to experience FOMO, anxiety, excitement, fear, greed, and every other intense emotion that markets generate, while maintaining the behavioral discipline to follow your predetermined plan, regardless of what you're feeling. This is extraordinarily difficult, and it's why most people never succeed at trading despite having adequate intelligence, education, and access to information. They can learn the technical analysis. They can understand the fundamental factors. They can memorize the patterns and indicators and strategies. But they cannot sit on their hands when every fiber of their being is screaming at them to do something. The traders who make it, the ones who actually build wealth through trading rather than just spinning their wheels or losing money, are the ones who develop what psychologists call distress tolerance. This is the ability to experience uncomfortable emotions without immediately acting to make those emotions go away. In everyday life, when you feel bored, you reach for your phone. When you feel anxious, you distract yourself with entertainment. When you feel uncertain, you seek information or reassurance. These coping strategies are generally harmless or even helpful in normal contexts. But in trading, these same coping strategies lead you to take unnecessary trades because trading temporarily relieves the discomfort of sitting still. Building distress tolerance in trading requires practice in the same way that building physical strength requires practice. You have to deliberately expose yourself to the discomfort of not trading and sit with that discomfort without escaping it. This is why I assigned Marcus that 30-day no-trading exercise earlier in our story. The exercise wasn't primarily about learning market patterns, though that was a nice side benefit. The exercise was about building his capacity to feel the discomfort of missing opportunities without acting on that discomfort. Every day he didn't trade was like a training session at the gym for his emotional regulation system. The first days were excruciating. The middle days were merely uncomfortable. The later days started to feel almost normal. By the end, he had built enough distress tolerance that he could watch the markets move without feeling compelled to participate. And that ability is worth more than any technical analysis skill he could have learned. If you want to dramatically improve your trading results, I encourage you to try a similar exercise. Not forever, not as a permanent approach, but as a deliberate practice period to reset your relationship with trading and build the psychological muscles that patience requires. Choose a time frame that feels genuinely challenging but not completely impossible. If you currently trade several times per week, commit to 30 days of no trading. If you currently trade several times per day, commit to just 1 week. The specific duration matters less than the experience of sitting through that entire period while markets move. Opportunities appear, and your brain begs you to take action. During this practice period, continue doing everything else you normally do. Watch the markets, analyze charts, research companies, identify potential trades and document them in your journal. Do everything except put money at risk. This distinction is crucial because you're not trying to disengage from the markets. You're trying to decouple market observation from trading action. You're building the ability to watch without acting, to analyze without executing, to see opportunity without feeling compelled to seize it immediately. This is the opposite of what most trading education teaches, which is to be ready to act instantly when opportunity appears. What I'm suggesting is that the ability to not act instantly, even when opportunity appears, is actually the more valuable skill. At the end of your no trading period, review every potential trade you identified but didn't take. Look at how they actually played out. You'll almost certainly find that a substantial percentage of setups that looked compelling in the moment either never triggered at your intended entry point, reversed before reaching your profit target, or otherwise didn't work as well as you expected. This empirical evidence that waiting often saves you from bad trades is powerful reinforcement for developing patience as your default mode rather than your exception mode. Now let's talk about the economics of patience in more detail, because understanding the financial mathematics behind this concept makes it much easier to maintain patient behavior when your emotions are pushing you toward action. Imagine two traders, both starting with $50,000 in capital, both trading the same market over the course of 1 year. Trader A is active, making approximately 100 trades over the year. Trader B is patient, making approximately 10 trades over the year. Let's assume both traders have exactly the same win rate of 60% and exactly the same average risk-reward ratio of 1 to 2. Meaning they risk $1 to make $2 on average. On paper, these traders have identical edge. They're both profitable traders with skills above the average. But watch what happens when we factor in realistic costs. Trader A, making 100 trades, pays about $10 per trade in commissions and spreads. That's $1,000 in direct costs. Additionally, Trader A experiences slippage and market impact on entries and exits, which realistically costs another $5 to $10 per trade. Let's call it $700 in additional hidden costs. Total trading costs for Trader A are about $1,700 for the year. Trader B, making 10 trades, pays about $100 in commissions and spreads, and maybe $70 in slippage and impact costs. Total costs for Trader B are about $170. Before we even look at the quality of their trades, Trader B is $1,530 ahead just from lower costs. But it gets better for Trader B. Because Trader B is only taking 10 trades per year, they can afford to be extremely selective. These 10 trades represent the absolute cream of the crop, the opportunities where everything aligns perfectly. Realistically, Trader B's actual win rate on these carefully selected trades is probably closer to 70 or 75% rather than 60%, and their risk-reward ratio is probably closer to 1 to 3 rather than 1 to 2. Meanwhile, Trader A's 100 trades include a mix of excellent, good, mediocre, and poor opportunities, because there simply aren't 100 excellent opportunities per year in most markets. Realistically, Trader A's actual win rate might be more like 55%, and their actual risk-reward might be closer to 1 to 1.5. Now let's calculate actual returns. Trader A with 100 trades, 55% win rate, risking 2% of capital per trade with a 1 to 1.5 risk-reward ratio, will end the year up approximately 35% before costs. After costs of $1,700, they're up about 32%. Trader B with 10 trades, 70% win rate, risking 2% of capital per trade with a 1 to 3 risk-reward ratio will end the year up approximately 32% before costs. After costs of only $170, they're still up almost 32%. Same net return, but look at the difference in experience. Trader A made 100 trading decisions, experienced the emotional roller coaster of 100 entries and exits, spent hundreds of hours monitoring positions and analyzing charts, and probably experienced significant stress throughout the year. Trader B made 10 trading decisions, had a much smoother emotional experience with far fewer positions to monitor, spent their time watching and learning rather than constantly trading, and probably felt relatively calm and in control throughout the year. Same money, wildly different experiences. And we haven't even factored in the long-term psychological benefits that Trader B is accumulating. Every year that Trader B practices this patient approach, they're reinforcing habits that will serve them for their entire trading career. Every year that Trader A practices their active approach, they're reinforcing habits that will eventually burn them out or blow up their account. This is why patience isn't just an advantage. It's the advantage. It's the one edge that never gets arbitraged away by better technology or smarter competitors. The markets can't eliminate your ability to wait. Algorithms can't outpatient you. The only person who can take away your patience edge is you, by choosing action over restraint, by giving in to the emotional discomfort of sitting still, by convincing yourself that this time is different or that these rules don't apply in this specific situation. I want to close by talking about what trading actually looks like when you fully embrace patience as your primary strategy. It doesn't look like the movies or the commercials or the social media posts showing traders intensely focused on multiple screens with prices flashing everywhere. It looks boring. It looks like someone who spends 90% of their time watching and learning and only 10% of their time actually trading. It looks like long stretches where nothing happens, interrupted by brief periods of focused activity. It looks like discipline and routine and consistencies rather than excitement and drama and constant stimulation. When people visit my office expecting to see a day trading setup with 6 monitors and constant action, they're always disappointed or confused by what they actually find. I have one monitor. I check the markets once in the morning and once in the afternoon. I spend maybe 30 minutes per day but actively looking at charts and prices. The rest of my time is spent reading, researching, thinking, writing in my trading journal, or doing completely non-trading activities. This seems impossibly boring to people who are addicted to the action and stimulation of active trading. But to me, it's freedom. It's the ability to be profitable without being chained to screens. It's the luxury of making decisions from a calm, thoughtful state rather than a reactive, emotional state. It's knowing that I'm not leaving money on the table by missing opportunities because I'm not trying to catch every opportunity. I'm only trying to catch the ones where my edge is overwhelming. The path from where you are now to this kind of patient, sustainable trading is not quick or easy, but it is simple. Start by tracking your current trading frequency and consciously reducing it. If you're making 10 trades per month, aim for 8, then 6, then 4. At each level, force yourself to become more selective about what qualifies as a tradable opportunity. You'll notice that your results probably improve at each step down in frequency. You'll notice that trading becomes less stressful. You'll notice that you start seeing patterns and opportunities that you missed when you were constantly active. Eventually, you'll reach a frequency that feels right for your personality, your strategy, and your life circumstances. For some traders, that might be 1 trade per month. For others, it might be 1 per week. The specific number matters less than the process of deliberately choosing patience over action, quality over quantity, and selectivity over activity. Understand that this transformation will be uncomfortable. Your brain will resist. You'll feel like you're missing out. You'll question whether you're being too conservative. This discomfort is not a sign that you're doing something wrong. This discomfort is proof that you're doing something right, that you're fighting against maladaptive instincts and building better habits. Embrace the discomfort. Sit with it. Let it wash over you without acting on it. This is the work. This is what separates traders who make it from traders who don't. Every moment you choose to wait instead of trade, you're making an investment in your future trading success that will compound over time. Every trade you don't take because it doesn't meet your criteria is making you stronger, smarter, and more disciplined. Every day you spend watching without acting is building the pattern recognition skills and emotional regulation capacity that professional trading requires. This isn't glamorous. This isn't exciting. This isn't what anyone shows you in trading advertisements or social media posts. But this is what works. This is what the data shows. This is what successful traders actually do, as opposed to what they say they do or what the industry wants you to think they do. Waiting is your real advantage in trading, not because it's magical or mystical, but because it's the one thing that most traders simply will not do. They can't sit still. They can't tolerate the discomfort. They can't resist the temptation. And because they can't, you don't have to beat them with better analysis or faster execution or more insider information. You just have to be willing to do the one thing they won't do, which is wait for opportunities that meet your standards rather than forcing trades that don't. If you can build this single skill, if you can develop the capacity to watch markets move without feeling compelled to participate, unless your specific criteria are met, you will have an advantage that most traders never develop, and that advantage will serve you for your entire trading career regardless of how markets change, how technology evolves, or how competition increases. The ability to wait is timeless, powerful, and completely within your control. The only question is whether you're willing to do the uncomfortable work of building it.